And we're going to talk about how corporations are structured, which really will lead into the accounting side of what is stock and how do we account for stock transactions in a corporation. That's the more accounting part of it, right? Accounting is weird. I don't know if you've noticed, but like if you thought like I'm going to learn more about how money works, and then you took this class and you're like, I don't think it's really about how money works. It's just about a system for recording transactions that involve money, right? And so it's a really narrow accounting is a narrow subset of how we deal with money, and it's the more like technical, if you want to put it that way, side of that. Like how do we record all these things happening? So it's not always what people think it is. You can usually count on everybody in an accounting class being a business major who has to take it. But then there's like that one person that's like, oh, I just had a free elective and I thought I'd take accounting. And you're like, okay, that's weird, but sure. Like I would take business law before I'd take accounting as an elective because I think law is interesting. But um, I don't know. I think accounting's interesting too, but that's why I kind of chose to go down that path because I think it's interesting. All right. So corporations. First of all, what a corporation is it's a way to structure a business. It's a very old way. Like almost as long as people have been doing business, they came up with the corporation. And what a corporation does is it lets you own a business, but be separate and distinct from the decision making of the business, which sounds bad, but the good thing about it is it frees you up from the work of having to worry about the business, and it frees you up from the liability. Like if the business does something bad and they get sued, you as the owner are not getting sued. Okay. The owners of corporations are called stockholders. So that like just link those two words together in your brain. Stockholder is an owner. Okay. But it's a sort of passive form of ownership. The stockholder invests money into the business. And what they're doing is instead of loaning money to the business, they're actually buying a portion of ownership in the business, but they're not buying any of the management responsibility of owning a business. So they're investing, they're a passive owner. They do have one active right as owners. It's not to manage the company day by day, but it is to elect a board of directors. So stockholders vote and they elect a board of directors. So the board of directors elected by the owners, the stockholders, and the board of directors now they hire the officers. So you hear of like the CEO of the corporation, that's the chief executive officer, and they are hired by the board of directors. The chief financial officer, the all those senior officers hired by the board of directors, or at least in part. A lot of times they'll hire the CEO, then the CEO will make the hiring decisions for the rest of the senior team and just get the approval of the board of directors. That's often how it works. And then the officers of the company, they hire the employees. They're responsible for their different areas. And again, they don't hire them directly. They usually have an HR department that's involved, but they are responsible for the processes. So this is how corporations are set up. So if you own stock, maybe you've invested, you have a Robinhood account and you bought 100 shares of some penny stock. What that means is you're a part owner of that company and you have a right to vote in their annual board of directors selection votes. Okay. Um, all right. So that's the corporate structure and kind of how it's laid out and how it works. So I mentioned some of these things already, but the advantages and disadvantages of corporations. So these are the advantages. They have separate legal existence. So the law actually recognizes a corporation as a person. It's a separate entity from its owners. Whereas if you had a sole proprietorship, that's a business where you just like start selling stuff or whatever. Like let's say you make crafts and you start selling them to people, that you're a sole proprietor. You and the business are indistinct, meaning you're one entity. Meaning if someone bought something you sold and then they died from it, they wouldn't just be suing the business, they'd be suing you. Okay. So separate legal existence. It has continuous life. Even if the owners or the founders of the corporation die, the corporation continues on. That's a plus. They can raise large amounts of capital, meaning they can borrow or sell portions of ownership to raise big chunks of money. The ownership rights are easily transferable. If I own 100 shares of stock in a company, I could just agree with you to buy them, and you give me money and I give you the stock, and I've transferred my ownership just like that. Nice and easy. And then they have limited liability, which means the shareholders are separate from the company when it comes to the company being sued. Okay, like, which is nice. I'd like to invest in a company, but I don't want to get sued. So if a company does get sued, and let's say it gets sued so bad it loses $1 billion, the only thing that's going to happen to me is I might lose money on the investment. Like the value of the stock could drop and I would lose money. But they're not going to come after my house. They're not going to come after all my other assets. Like the biggest risk to you as a shareholder of a corporation is that you could lose your entire investment into that corporation, but not any of your other assets. Whereas if you just own a regular business, you could lose everything. They could come after you. There's the disadvantages. The owner's separate from management. It sometimes happens that the person who starts a corporation, then they sell off a bunch of their stock to raise funds. If they sell off too much of their stock, like more than 50%, 50.1% of their stock, and those 50.1% of stockholders all agree, then at the board of directors meeting, at the stockholders meeting, they could elect a new board of directors, and that new board of directors could fire them, the person who started the company as the CEO, and hire a new one, right? So that sort of thing is scary to you if you started the company and it's your baby, but you had to sell off a big chunk of your ownership in order to like raise the funds to take it to the next level or whatever. In theory, they could vote you out and then you'd be gone. You'd still be a minority shareholder, but you'd be just a passive investor like everyone else. So that's a little terrifying. From an accounting standpoint, this is a big one. We're worried about double taxation of dividends, which means when because a corporation is a separate legal entity, they have to file their own tax return. So they get all their revenues minus their expenses as their net income, and they have to file a tax return on that net income and pay taxes on that net income. Then a portion of that net income gets paid to the owners as dividends, and they get charged taxes on those dividends again. So when it's a small corporation that's owned by just a small group of people, that really feels like you're being double taxed. When it's a big, like if I invest in Microsoft, it doesn't feel as much like that because it's just like I have this stock, it paid me a dividend, and then I had to pay a 15% tax on the dividends, and that was it. But that's the real issue. And finally, regulatory costs when you're going to make a corporation, especially if it's big enough that its shares are being publicly traded, tons of regulations, and the cost of sort of following all those regulations and having the people in place to follow all those rules can be pretty significant. And so a lot of times people like to stay small to avoid those costs. But you hit some point where you're like, do we want to grow and get stupid rich? Or do we want to stay small? There's a trade-off. Stupid rich is not as exciting as it sounds. Well, says I don't know. I'm not stupid rich. I'm not even not stupid rich. I'm just like comfortable. All right. So here's some terms you need to know about stock before we get in how to deal with stock. You need to understand that the charter of a corporation will specify how many shares of stock are authorized for the corporation. In other words, the number of shares the company can be divided into. So it'll say like, oh, this company can be divided into 10 million shares of stock. So authorized means they could issue that many shares of stock. Issued shares of stock means the number of shares that they've actually sold. And then outstanding is all shares that they've sold that haven't been bought back by the company. Because think about what's happening. The reason we issue stock is to raise capital or funds for the business. So like, if, okay, we'll say if Brickell starts a company and she decides I really need money to do this, to get to the next level with this company, I'm going to sell off 1 million shares at $5 a piece, because that's what the market will pay for them, to get $5 million. What she would like to do, I'm guessing, since it's her company, is she would like to eventually buy those shares back so that she doesn't have a bunch of other owners out there. But right now, she needs the money to grow the company. So owners will issue shares, and now they have to share ownership with other people. But as the company starts to do well, they'll put out and say, hey, all of you who paid $5 a share for my stock, we're willing to pay $12 a share for it now to buy it back from you. And so outstanding shares are shares that were authorized and issued minus any that were bought back. Those are the ones that are outstanding. Okay. So that's the terms we need to know. So there might have been, what we say? How many did I say? 1 million shares? 1 million shares. Let's say our charter authorized us to sell 10 million shares, but we only issued 1 million. And then of those million, we did a buyback at some point and bought back 300,000 of them. So we would say 700,000 of those million that were issued are still outstanding. The other 300,000 are owned by the company as something that's and usually they don't like retire them, they just own them, because a lot of companies will use those then for like employee benefits, or like for a senior employee who's like the CEO. Like Elon Musk, he doesn't get paid like a cash salary, he gets paid in stock, or even he gets paid in stock options, which is like a contract that says you can buy this many shares of Tesla stock at this price. And so even if Tesla goes up to 100, he has the right on this option to buy it for 30. So, 30, so he could buy a bunch for 30 and immediately sell them at the market for 100 and get a bunch of money. But because he doesn't exercise the option, he's actually not getting any pay and doesn't have to pay any taxes. That's how the rich people, because he just got the option to. We just gave you the option to purchase this, right? This is how this is how some of the wealthy people get around paying some of the taxes. Do you remember the interview with Trump when they were like, what are you going to do? Or do these loopholes even exist? Everybody talks about them. He's like, I know they exist because I use them. This is before, like, he's like, I'm not stupid. Like, how do you become a billionaire? Apparently by knowing stuff the rest of us. It's not really that they know something we don't know. It's that most of us don't have the opportunity to get paid in stock options, right? All right. There are two types of stockholders: common stockholders and preferred stockholders. Two types of stock: common stock and preferred stock. And what makes preferred stockholders preferred is they get dividends before the common stockholders. So what happens is a company does business for a year and they go, look, we made a profit of, $10 million. And then they get together and they vote, the board of directors votes and says, how much of this do we want to pay out to the shareholders as a dividend? And so if they say, let's do 10% of our profits, so 1 million of those $10 million, then they say, all right, what are the preferred shareholders owed? They pay them off, and any money left over goes to the common shareholders. Okay. Preferred stock is a special class of stock. It's called non-voting stock. So even though it's called preferred, they don't get to choose the board of directors. It's the common shareholders who do. So what makes it preferred is they usually get a set or guaranteed amount of dividend, and they get their dividends first. Okay. And that'll come up in some of the ways we have to record it in the future here. Okay. So now we're getting down to the accounting of it. Here's what it looks like. So we have a corporation is authorized to issue 10,000 shares of $100 par preferred stock and 100,000 shares of $20 par common stock. Corporation issues 5,000 shares of preferred stock and 50,000 shares of common stock. They're issuing half of what they're allowed to. So here's what the entry will look like. There's a couple terms in here that I'll unpack for you in a minute, but I just want to show you what the journal entry looks like. So if they issue Would they say 5,000 shares of preferred stock at $100 par? It'll be five or 5,000 times $100, 500,000, and 50,000 shares of common stock at par. And the total amount of cash they raised was 1.5 million. Remember way back in the beginning when we were learning about equity, and equity is confusing. And I would say all stock is, or all that like common stock account, or now we've learned about preferred stock, just represents money paid into the outcome, the corporation or the business by the owners. Okay. So it's a credit and it's part of our equity. The owners have paid in 1.5 million and we got cash of 1.5 million we can now use to run the business, to do whatever we need to do to grow the business. Okay. The term that's confusing on this is par, right? The golfers know the term. Again, it's supposed to mean average, but we know that if you can golf par all the time, you're a pretty decent golfer, right? You're not just average, you're well above average. But all par means as it relates to stock is some base price set in the corporate charter. It doesn't have any predicate of value other than that. Okay. Some states, so states are the authorities when it comes to creating corporations. Some states require businesses, when they incorporate, to name a par value for their stock. Other states don't. They're called no par corporations, and you don't have to name a par value. Okay. But it creates this weird confusion when we're doing entries that you'll see in a minute that is like unnecessarily confusing, but it's just how it is. So all we have to know is that all that par means is the base valuation of the stock. But really, in real life, the valuation of stock has a lot more to do with the market. Whatever people are willing to pay for the stock, that's what you're going to get for it, regardless of what its par value is. So they can sell for less than par or more than par and all sorts of stuff. And it's confusing, but it doesn't need to be. And we'll walk through how we do it. All right. So sometimes, because the market is doing more, willing to pay more, we'll sell our stock at a premium to its par value. Oh, premium again. It's confusing, right? So all it means is like here we have this company, they're issuing 2,000 shares of stock for cash at $55, even though it's $50 par stock. Okay. So the only thing confusing about it is we always record the preferred stock or the common stock entry at its par value. So if this has a par value of 50 and we sell 2,000 shares, 2,000 shares times 50 is 100,000. And then any money above that, so the additional $5 per share is going to be recorded as paid in capital in excess of par on the stock. It's again, I think it's unnecessarily confusing, but it's a remnant of how this was done in the olden days. So we always do preferred stock or common stock at the par value, and then any money we were paid in excess of that par value gets its own separate line, okay, and it's separate account in our books. And then the debit to cash. So when stock is being issued, we're always debiting cash. That's the point of issuing stock. We're selling off a portion of the company for cash. So let's take a look at our first guided assignment question and see what we learn. Um, oh, I was like, this does not look right. It's because I clicked on the individual assignment. Hold on. I was like, that's a lot of problems for a guided. Sorry, guys. What the heck? All right, that's more like it. All right. So January 22nd, Jefferson County Rocks Incorporated, a marble contractor, issued for cash 210,000 shares of $30 par common stock at $34 and issued for cash 15,000 shares of preferred stock, $9 par at $12. So in both of these cases, they're issuing it for more than the par value of the stock. So remember, whenever we're doing this, the debit's going to be cash. Why are we issuing stock? Well, so we can raise some money. Okay. Why else would you sell off a portion of something you own? All right. So we're going to record common stock. And so here we're issuing 210,000 shares, $30 par for $34. So the way we have to record this is 210,000 shares times $30. That's going to be the amount of common stock. And then 210,000 shares times any amount over the par value, which was what we issue it for, 34. So we issue $4. And that's how we're going to record it. This will be our common stock figure, and this will be our paid in capital in addition to common stock. Or so that's going to be paid in capital in excess of par on the common stock. So 210,000 times $30. Anybody do that math already? $6,300,000. Does that sound right? And then for the paid in capital in excess of par, it's going to be 210,000 times 4, or 840,000. And then we just add the two together, right? And that'll tell us how much cash we got total. So 7,140,000. So this would be perfectly straightforward if there wasn't this whole in excess of par value, right? Like that's the part that's most confusing. And even that's not crazy if you're just like, okay, I take the par value times the number of shares. That gives me the common stock. And then I take any amount over and above that par value times the number of shares, and that gives me the paid in capital in excess of par value. That's it. Okay. So that's not too crazy once you get used to it. It's a little crazy at first because it's new. And then for the issuance of the preferred stock, again, we'll debit cash, we'll credit preferred stock, and we'll credit paid in capital in excess of par on the preferred stock. And again, so it says 15,000 shares of preferred stock. And the par value of the preferred stock is $9. And then 15,000 shares at any amount above the preferred. So it issued them for 12. So if the par was 9, then the amount in addition to par would be $3 per share, right? So 15,000 shares times $9 per share. So the par value on my preferred stock is 135,000. And 15,000 shares times $3 in excess of par is $45,000 of additional paid in capital. Add those two together. What is the total amount invested or total paid in capital by all stockholders? We would just add the amount of cash we got from the two transactions. Okay. So what is that? 320. So that's how we record basic stock transactions. We credit common stock for the par value of the stock times the number of shares issued, and we credit paid in capital in excess of stock for any amount over and above that par value times the number of shares, and then add those amounts up, and that tells us the total cash we got from that investment. Not too bad once you get used to it. All right, I mentioned some states allow for no par stock, which makes our lives easier. So assume on January 9th, the corporation issues 10,000 shares of no par common stock at $40 per share. They just record cash, 10,000 shares times 40, so cash of 400,000, common stock of 400,000. No worrying about that par or any amount in excess of the par. Then on June 27th, they issue an additional 1,000 shares at $36. They just do cash, common stock. So with no par stock, there's just no worrying about that in addition to par. Whatever you issue it for, you'll debit cash and credit common stock for that amount. So it actually makes life easier. I think more states should just go to that. I don't know why. There probably is some reason for par value that I'm too dense to consider, but to me, I'm just like, creates this extra step from an accounting standpoint. So we'll look at the second question, get an example of how that's set up. All right, on May 15th, Helena, anybody from Montana? I think it's Helena, not Helena. Helena Carpet Inc., a carpet wholesaler, issued 750,000 shares no par common stock with a stated value of $1.50 at $4. On June 30th, it issued for cash 17,500 shares of preferred stock, $50 par at $60. So journalize the entries on May 15th and 30th, assuming that the common stock is to be credited with the stated value. Okay, so this one, some states have what they call stated value, which is pretty much the same as par value. Other states have just no par at all. So again, they have to tell us that. So if it wants us to credit it with a stated value, then we're going to do that just like we did the par value ones up here. So we'll always debit cash. We'll credit common stock, and then we'll do paid in capital in excess of stated value on the common stock. So stated value and par value, they may mean something a little different legally, but from the perspective of me as an accountant, I just know if it has a par value or a stated value that I'm going to have to separate out the amount that was at its stated value and the amount that is just is in excess of that. All right. So in this case, if they issued 750,000 shares, at a stated value of $1.50 a share, and then they sold it for more than that, they sold it for $4 a share. So that's going to be the amount in excess of the stated value. So that's 750,000 times $1.50. That's 1,125,000. And then 750,000 times 250. That's the amount they got over and above the stated value. $1,875,000 And it looks like they got a total of $4 million. On the preferred stock, 17,500 shares of $50 par. They issued them for $60. So again, we'll debit cash, credit preferred stock, and credit paid in capital in excess of par. The preferred stock has a $50 par value, so we'll do 17,500 shares times $50. There's its par value, and 17,500 shares times any amount in excess of that par. So if they issued them for 60, the amount of excess is $10 per share. Okay. So again, oh, thank you. I did bad math. 3 million. I'm a good accountant. I can make $1 million materialize out of thin air. All right. So for the preferred stock, then we'll do 17,500 shares times the par price of $50, 875,000. And then the preferred is an additional $10 per share, so 17,500 times 10. So what's the total amount invested by all stockholders? Again, we'll just add up the cash. 4 million. All right. So here's the point of all these two exercises. Whether they call it par value or they call it stated value, all we do is we figure out how much the stock is at its par or stated value, multiply that by the number of shares. That will give us the common stock or preferred stock entry. And then any amount over and above that, multiplied by the number of shares, is give us the paid in capital in excess of whether it be stated or par value. And then some we'll see won't have any of that, and it'll just all be, there'll be no par value to worry about, and you'll just multiply the number of shares by times the amount you issued them for. Okay. So it's not crazy. It's just new. Okay. So let's move on. All right. So one of the reasons we like to invest in companies, wake up. You were nodding off. How can you nod off with the riveting excitement of this class? Did you just scoff? That was rude. This is my life's work. How dare you? All right. You're like, no, it's not the subject matter that's boring. It's you, Fox. You're boring AF. I should get a shirt. Should I get one that for the first day of accounting? All right. That'd be funny. All right. So the reason we like to invest in stocks is because when a company makes a profit, we get to share in that profit. And the sharing of the profit of the company with the owners is called a dividend. Anytime a company makes money, the board of directors, well, the senior officers together with the board of directors will decide how much of this do we want to retain in the company for future growth, and how much of this profit do we want to pay out to the owners, right? When they pay that money out to the owners, that's called a dividend. So what happens is the board of directors just votes and they decide how much dividend they're going to pay. So they're going to do preferred stock, $100 par. They're going to pay $2.50 per share. So you just take 5,000 shares, the number of shares outstanding, times the amount of dividends per share. That'll be the total amount of dividend that they're paying. For the common stock, there's 100,000 shares outstanding. They're going to pay 30 cents a share. So there'll be 30,000 in total dividends. So they'll pay a total of $42,500 in dividends. And so the journal entry will look like this. We debit cash dividends, and then we credit cash dividends payable. There's a couple of dates we have to understand when it comes to dividends. The first is called the declaration date. This is the date the company sort of announces we're going to pay a dividend. So when they do that, here's what it looks like. You debit cash dividends account and you credit the cash dividends payable. So we haven't paid them yet. We've just declared if you're a shareholder, we're going to pay a dividend. The second date is called the date of record. That's what they'll say is if you're a shareholder as of this date, you're going to get a dividend. And so that date, nothing happens financially. It's just the date people have to be owners of the stock by in order to participate in or receive that dividend. So on November 10th, which is the date of record, no entries necessary. It just determines which stockholders will receive the dividends. And then December 2nd is the date of payment. So that's the third one we have to know about. And the date of payment will debit cash dividends payable and credit cash because we're actually paying out the cash now. So those are three terms you need to know when dealing with dividends is the what did I just call it? My brain just flubbed. The declared or declaration date, the date of record, and the date of payment. Declaration date creates a journal entry for the accountant of cash dividends and dividends payable. The date of record, no entry necessary. The date of payment creates an entry of dividends payable on the debit and then cash on the credit. We're actually paying it out. At the end of the period, we always close out dividends. Remember, that was way back in chapter 4 when we learned about closing entries. So let's take a look at question number 3 to get an example of how this works. All right. You can see you're excited about it. Whoops, clicked on the wrong one. All right. So the declaration, record, and payment dates in connection with a cash dividend of $1,425,000 on a corporation's common stock are July 9th, August 31st, and October 1st. Journalize the entries required on each date. If no entry is required, select no entry required. All right. So when they declare it, we're going to do cash dividends and cash dividends payable, 1,425,000. Whoops, too many zeros. What happens on the data record? No entry required. But if you're a shareholder, you know that's the date or if you were thinking of being a shareholder, you have to buy the stock and be an owner of it as of that date. Okay. Then on October 1st, we're going to do cash dividends payable will be debited and cash will be credited. So in essence, when we declare the dividend, we create a payable. We now owe that money. We've promised it. Okay. And then when we actually pay it, we no longer owe that money. So the amount we owes or the payable goes down and the cash goes down because we're paying it. You're like, well, that was incredibly easy. Like, it's not easy. I'm just an incredible teacher. Humble too. I can get my humble AF shirt to go with my maybe like blessed AF. That'd be pretty good. I told my wife I wanted humble AF shirts for a family reunion and she wouldn't go for it. Yeah. All right. So we are out of time. We'll finish the last one of these tomorrow. Okay. And then as we finish the other things. But maybe I shouldn't have spent all my time making AF jokes. Uh, it means as flip, in case you were wondering, as I'm a nice person, sort of. Anyway, have a good day. Don't forget to find joy in the journey. How's that? You know what I hate about things like that? Is like they're true. You should find joy in the journey, but when someone puts it like that, I'm like, I refuse. I will not find joy in the journey. You can't tell me how to live my life.